Have you ever wondered why everyone is talking about the bond market? What's going on that's making investors and economists so worried? In this video, we're going to break down the mysteries of the bond market, understand why it's in turmoil, and how it can directly impact your wallet. Get ready for an eye-opening journey that might just change how you see your investments and personal finances. Don't forget to like, share, and subscribe to the channel for more content like this. What is the bond market? The bond market is a financial environment where investors lend money to entities like companies or governments in exchange for interest payments over time. This mechanism is crucial for the economy to function, as it allows governments to fund public projects and companies to raise money for expansion. Unlike the stock market, where you become a shareholder in a company, buying a bond makes you a lender expecting to get your money back with interest. This distinction is key to understanding the risks and reward of each investment type, as bonds generally offer more safety, though with potentially lower returns than stocks. The bond market also acts as an important economic indicator, reflecting how confident investors are in the issuer's ability to repay its debts. For example, if you buy shares of McDonald's MCD, you become part owner of the company and can earn money from dividends and stock price increases. But this investment is subject to market swings in the company's performance, which could lead to significant losses during downturns. On the other hand, when you buy a bond issued by McDonald's, you're lending money to the company and will receive fixed interest payments regardless of its business performance, unless it goes bankrupt. This predictability makes bonds attractive for more conservative investors who prioritize stability over potentially higher but more volatile gains. When it comes to U.S. government bonds, known as treasuries, there are different types. T-bills, maturing in up to 1 year, T-notes, maturing in 2 to 10 years, and T-bonds, maturing in 20 or 30 years. These bonds are considered low-risk investments because the U.S. government can print money or raise taxes to repay its debts, making default extremely unlikely. This security means they're seen as safe havens during times of economic uncertainty, drawing in global investors looking to protect their capital during financial crises or geopolitical instability. Plus, the income from these bonds is exempt from state and local taxes in the U.S., making them even more appealing to those seeking safety and stability. This tax advantage boosts the net return for bondholders, especially in states with high tax rates, where the difference can really add up over time. However, it's important to note that earnings from treasuries are still subject to federal taxes, so investors should factor that into their financial planning. Why is the bond market in turmoil? Falling bond prices, rising yields. When many investors start selling their bonds, the market supply of these assets jumps, creating an imbalance between supply and demand. This oversupply pushes bond prices down, which in turn causes yields, interest rates, to rise to attract new buyers, since yield is inversely linked to bond price. It's the market's natural way of adjusting to reflect higher perceived risks and to make up for the weaker demand for these assets during uncertain economic times. This jump in interest rates has direct and widespread effects on the economy, creating a domino effect across different sectors. For governments, it means the cost of financing their debt shoots up, putting more strain on public budgets and limiting funds for infrastructure and social programs. For everyday people, higher rates directly affect loans, mortgages, and credit cards, making borrowing more expensive and cutting into household and business spending. This dynamic can slow down the economy as people and companies scale back their expenses due to the higher cost of money, potentially leading to a broader economic slowdown. Why are bonds being sold off? One major reason for the wave of bond selling is growing worry about the U.S. debt, which has hit record levels in recent years. In May 2025, Moody's downgraded the U.S. credit rating, citing concerns about the ballooning national debt, now over $36 trillion and still climbing fast. This downgrade signals to investors that the risk of default, while still low, is on the rise, leading many to rethink their positions in U.S. treasuries and look for better risk-return alternatives in a shaky fiscal environment. On top of that, complex geopolitical factors are fueling market uncertainty and volatility. China, for instance, has been steadily reducing its holdings of U.S. treasuries as part of a broader strategy to diversify its foreign reserves, hinting at a potential economic decoupling between the world's two largest economies. Trade tensions and tariffs add to the global uncertainty, pushing investors to seek safer or alternative assets like gold or strong currencies from other developed countries. China's pullback as one of the biggest buyers of U.S. bonds drives down bond prices and pushes yields higher, worsening the instability and making it even harder for the U.S. to finance its deficit. The role of the Federal Reserve. The Federal Reserve has been using expansionary monetary policies to respond to recent economic challenges, buying large amounts of government bonds to inject cash into the economy and stimulate growth. While this approach can boost economic activity in the short term, especially during crises, keeping it up for too long can trigger persistent inflation. Printing more money without a corresponding increase in production of goods and services usually erodes the currency's value, driving up prices across the board and shrinking people's purchasing power. Inflation acts like a hidden tax that quietly eats away at consumers' buying power as prices climb faster than wages in most sectors. Meanwhile, some companies with pricing power can pass these higher costs on to customers, preserving or even boosting their profit margins, which benefits shareholders but hurts the average consumer. This creates a worrying imbalance where a few sectors or individuals profit, while most people face growing financial pressure, deepening existing social and economic inequalities. Practical impacts for everyday people. Rising interest rates and skyrocketing inflation have serious and far-reaching effects on people's daily lives, forcing big changes in spending habits and quality of life. Living costs go up across the board, with food, housing, and transportation becoming more expensive month after month, squeezing family budgets. On top of that, credit becomes much more expensive. Mortgages, personal loans, and even credit card payments come with much higher interest rates that make borrowing nearly impossible for many. These changes force families to rethink their budgets, often cutting out non-essential spending on things like leisure and education just to stay afloat and cover basic needs. This economic strain hits family purchasing power hard, pushing people to make tough choices about what to spend on and leading to a slow but steady decline in living standards. Families might have to switch to cheaper, lower-quality products and put off big plans like buying a home. Retirees and people on fixed incomes are especially vulnerable, as their earnings don't keep up with rising prices, steadily eroding their ability to cover living costs and putting their financial security and retirement at risk. For investors, for both seasoned and beginner investors, the current environment offers a tricky mix of promising opportunities and significant risks that require careful analysis. Bonds with higher interest rates can be very appealing for those looking for fixed income in a high-rate environment, delivering better nominal returns than in recent years. But the growing economic instability and rising risk of default also mean investors need to be extra cautious and carefully evaluate the financial health of bond issuers. It's wise to focus on issuers with solid balance sheets, high credit ratings, and a consistent payment history, even if it means accepting slightly lower returns. It's crucial for investors to adopt strong diversification strategies and stay on top of market developments, relying on trustworthy information and expert advice to make informed decisions. Diversifying investments across asset classes, like defensive stocks, bonds from various issuers and maturities, commodities, and even foreign currencies, helps spread out risk and seize opportunities in different areas. And keeping a cash reserve becomes especially important in this volatile market, so investors can take advantage of sudden opportunities that pop up during market corrections. Future scenarios. If rates keep rising. If interest rates keep climbing for an extended period, the economy could see a steep slowdown as companies cut back on investment and people cut back on spending. This could lead to a technical recession or even a deeper economic contraction, with worrying spikes in unemployment and drops in industrial production and GDP, setting off a vicious cycle of shrinking consumption and production. Companies that rely heavily on credit to operate or grow could face extreme financial pressure, slashing investments and laying off large numbers of workers, further hurting the economy and causing ripple effects throughout supply chains. At the same time, the U.S. government's debt burden could reach truly unsustainable levels in this scenario, forcing it to take unpopular steps like hiking taxes significantly or turning to unchecked money printing. These measures could only make inflation and economic instability worse, creating a scenario of stagflation that's especially hard to tackle, where the economy stalls or shrinks while prices keep soaring. This could turn into a prolonged period of stagflation similar to what happened in the 1970s, creating a tough environment for monetary and fiscal policies that could struggle to fix the problem without making things worse. If the Fed cuts rates. On the other hand, if the Federal Reserve cuts rates too early or too aggressively in response to economic pressures, there could be temporary relief in credit markets, making loans more accessible and encouraging spending in the short term. But this well-meaning move could keep inflation structurally high for longer than ideal, steadily eroding people's purchasing power and distorting economic decisions. The Fed has to carefully balance these tricky decisions because overly aggressive monetary policies could spark even bigger inflation problems down the road, requiring even sharper rate hikes to get things under control, a risky yo-yo effect for economic stability. It's an extremely delicate balancing act that demands surgical precision, and the Fed's decisions will have major effects not just on the U.S. economy, but on the entire global financial system because of the dollar's central role. Both investors and everyday people need to keep a close eye on these changes and be ready to adjust their financial strategies as needed, staying flexible to navigate different scenarios. Clear, transparent, and consistent communication from the Fed will be crucial to avoid destabilizing market surprises and maintain investor and consumer confidence, key ingredients for a sustainable economic recovery. The timing and scope of these measures will be critical to the success or failure of this delicate economic maneuver. The bond market is at a critical juncture, reflecting concerns about public debt, monetary policies, and geopolitical tensions. Understanding these shifts is essential to protect your finances and make smarter investment decisions. Keep an eye on developments and always diversify your investments to manage risks. And remember, your journey to financial freedom starts now. Click the link in the video description to access a free ebook packed with investment secrets, mindset shifts, and wealth-building strategies.